Hey, what's going on, everybody? Friday wrap up time. Appreciate you tuning in. Sorry, it's been a couple of weeks since I was on here. Hopefully, you're staying warm amidst the freezing temperatures we got going on right now. So, typically, we'll talk about interest rates on this video series, but more importantly, I want to drill down to the Federal Reserve. So, last week, the Federal Reserve had their meeting that they do every 6 weeks. Yesterday, the Federal Reserve meeting minutes was released, and we got some good news, albeit 3 to 4 months from now. So, the Fed decided to end their balance sheet runoff. And what that means is at the end of every month, billions and billions of dollars of T bills or treasuries expire. So basically, if you bought a 10-year treasury in February of 2015, it expires at the end of this month. So what the Fed was doing was allowing that $50 billion worth to expire. Well, that's more or less flooding the market. And if you've watched these videos before, I've mentioned the more T bills you have in the market, the higher the rate of return has to be to entice the buyers. So basically, right now the 10-year treasury is at 4.5%, which means if I bought a 10-year treasury, I'm getting 4.5% return on my investment. But the more of those you have, the higher you have to raise the prices to entice buyers to buy. But what they're going to do starting in, I think it was end of July, while they let 50 billion roll off, they're buying back 50 billion. I know it's redundant, but what that does is it brings a very large buyer into the market to buy up the 10-year treasuries. So the more buyers you have, the lower the 10-year treasury and the 2-year treasury and the 30-year treasury go, because they're soaking up the liquidity. The lower the 10-year treasury goes, the lower our rates go. So this is good news. I want to show you the market this yesterday and today based on that news. So here we are. If you're new to these videos, green is good, red is bad. The higher this goes, the lower the rate. So this was the announcement yesterday, and we've pushed through 2 layers of resistance here. Looks like it's the 100-day moving average and the 200-day moving average. You can see how we bumped against them and we pushed back down. So we've broken through. Hopefully the momentum can continue, which will then get rates lower and lower. Now, I want to show you where we need to go to get into the fives. So this is where we were September, October, that's when I started quoting high fives for some people. We got a ways to go here still. However, this was good news. The market took it as such. And I know it's in July, but I think we'll get another big bump lower once this balance sheet runoff ends. So we'll continue to watch it for you guys. More and more people, there's a 6 in front of the rate, so we are getting lower. It's just going to take a little bit of time, and we'll keep watching it for you guys. If you have any questions or concerns, please reach out to me. I'm always around. See ya.